$54.69. That was the highest price a share of New Fortress Energy ever closed at back in August of 2022. By late June of 2026, that same share was trading for around 34 cents. The company's market value had fallen to roughly $148 million. For a business that once carried a market capitalization in the billions, that is a wipeout. New Fortress Energy builds and runs liquefied natural gas terminals, power plants, and pipelines in Puerto Rico, Jamaica, Mexico, and Brazil. Its founder, Wes Edens, built his fortune as a co-founder of Fortress Investment Group, and he is better known to sports fans as the owner of the Milwaukee Bucks. On the company's own website, Edens' team describes energy access not as a business opportunity, but as a human right. In March of 2026, the company that had spent a decade marketing itself as a moral mission announced it was restructuring roughly $5.7 billion in debt. The plan cuts that debt down to around $527 million, a reduction of about 91%. In the same filing, the company admitted something it had not said publicly before. Its financial statements had been misstated since 2023, 3 years of misstated books. The company's own auditor, Ernst & Young, signed off on the 2025 annual report with a formal note attached, warning of substantial doubt about the company's ability to continue as a going concern. That is one of the most serious warnings an accounting firm can put on paper. It landed on a company that, over the same stretch of years it was losing money, had paid out more than $1 billion in dividends to its shareholders and insiders. This kind of story has a name in American corporate history. In December of 2001, another energy company filed for what was then the largest corporate bankruptcy in the country's history. Its name was Enron. Enron was not a scrappy startup. It was Fortune's most admired corporation. For 6 years running, a company reporting close to $100 billion in revenue at its peak. It employed roughly 20,000 people. It marketed itself as reinventing how energy markets worked, much the way New Fortress markets itself today as reinventing energy access for the developing world. Like New Fortress, the collapse arrived after years of aggressive borrowing, ambitious language, and financial statements that turned out not to mean what investors thought they meant. Understanding how Enron got where it did helps explain where New Fortress might be headed. Enron started as a pipeline company, moving natural gas from one place to another. Under Chairman Ken Lay, it transformed itself into a trading operation that bet on the future price of everything from electricity to bandwidth. The man who drove that transformation was Jeffrey Skilling, who joined Enron on one condition, that the company adopt what is called mark-to-market accounting. Under that method, Enron could book the entire projected profit of a long-term contract the moment it signed the deal, whether or not the cash had actually come in yet. In practice, that meant Enron's reported earnings were often built on guesses about the future rather than money it had already collected. Skilling became president, then chief operating officer, then in February of 2001, chief executive officer, with Lay staying on as chairman. Behind him was chief financial officer Andrew Fastow, who built a network of off-balance sheet partnerships, the most infamous, known as the LJM partnerships, designed specifically to move debt off Enron's books and make the company look more profitable than it was. For years, it worked. Fortune magazine named Enron the most innovative company in America 6 years running, and in 2000, its best-managed company. Enron survived the dot-com crash almost untouched and told investors at analyst meetings in early 2001 that its broadband trading division was headed for explosive growth. Then, on August 14, 2001, Skilling abruptly resigned as chief executive, citing personal reasons. Inside the company, That resignation set off alarm bells. Weeks later, an Enron vice president named Sharon Watkins sent Lay an internal memo warning that the company's accounting practices could cause it to implode in a wave of accounting scandals. She was right. In October of 2001, Enron disclosed massive write-downs tied to Fastow's off-balance sheet partnerships, along with a reduction in shareholder equity. The board fired Fastow once it discovered he had personally embezzled more than $30 million through the very shell entities he had built to hide Enron's debt. Once outside, auditors and investigators went back through the books. The damage became clear. The restatement erased most of the profits Enron had reported between 1997 and 2000, added nearly $1 billion of debt back onto the balance sheet, and wiped out more than $1 billion of shareholder equity that had never really existed. On December 2, 2001, Enron filed for Chapter 11 bankruptcy, at the time the largest corporate bankruptcy in American history. The stock, which had traded above $90 a share in 2000, was worth less than $1 by the time the filing hit. Roughly 20,000 people lost their jobs. Many of them had also lost their retirement savings. Because Enron's pension plan was heavily invested in Enron's own stock, the same stock employees had been encouraged to buy and hold, even as executives were quietly selling shares of their own. The damage did not stop at Enron's own employees. Arthur Andersen, one of the 5 largest accounting firms in the country, and the firm responsible for auditing Enron's books, was convicted of obstruction of justice for its role in the scandal. That conviction was later overturned on appeal, but by then the firm had already lost its clients and effectively ceased to exist. Investors lost billions of dollars in shareholder value. Estimates range from around $11 billion to as high as $74 billion, depending on how the loss is measured. The fallout reached Washington. In 2002, Congress passed the Sarbanes-Oxley Act, rewriting the rules on corporate financial disclosure and auditor independence for every public company in the country. The men at the center of it faced criminal consequences. Skilling was convicted on multiple counts of fraud and conspiracy and sentenced to 24 years in prison, later reduced on appeal. He was released in 2019. Fastow pleaded guilty, cooperated with prosecutors, and served roughly 6 years. Lay was convicted as well, but he died in July of 2006 before he could be sentenced, and his conviction was later vacated as a result. Author Bethany McLean, who helped break the story, argued that Enron was never a fundamentally healthy company propped up by one rogue executive. It was a weak business that Fastow's accounting tricks temporarily disguised. Skilling himself never accepted that framing. In a 2001 television interview during the California energy crisis, he described his company this way: "We are the good guys. We are on the side of angels." The gap between that quote and what regulators found in Enron's books became, in the years since, the standard textbook example of the distance corporate language can travel from financial reality. It is the reason Enron's name is still shorthand, more than 2 decades later, for the kind of collapse where the growth story turns out to be the fraud. Set side by side, the shape of these 2 stories rhymes in specific, checkable ways. Both companies built themselves on heavy debt-funded expansion while marketing that expansion in language that reached well past ordinary business talk. Enron cast itself as reinventing how energy markets worked. New Fortress casts itself as delivering energy access as, in the company's own words, a human right. Both generated large, sustained losses while presenting themselves publicly as growth stories rather than distressed companies. New Fortress lost roughly $1.3 billion over the 12 months leading into its March 2026 restructuring announcement, according to the Institute for Energy Economics and Financial Analysis, a nonprofit research group that tracks the energy sector and by its own admission had never in its history generated a single cent of free cash flow. Both disclosed serious accounting and reporting problems just before the reckoning arrived. Enron's came in October of 2001. New Fortress's came in March of 2026, when the company admitted its financial statements had been misstated since 2023 and flagged multiple material weaknesses in its internal controls. In both cases, insiders extracted real value while the losses piled up. Enron executives sold shares while encouraging employees to keep buying. New Fortress paid out more than $1 billion in dividends to shareholders and insiders during the very years it was accumulating losses, but the differences matter just as much, and the biggest one is the difference between fraud and mismanagement. Enron's collapse rested on demonstrated, prosecuted, criminal fraud, fabricated profits, hidden debt funneled through shell partnerships, and executives who went to federal prison for it. As of this reporting, no New Fortress executive has been charged with or convicted of any crime. The allegations against the company describe serious governance and disclosure failures, not the same legal or factual category as what prosecutors proved against Enron. The mechanism of collapse is different too. Enron's reported profits were substantially fictional, engineered through mark-to-market accounting and off-balance sheet partnerships built specifically to deceive. New Fortress's losses, by contrast, appear to be real operating losses, high debt service costs, an underperforming floating gas plant off the coast of Mexico that analysts say consumes an unusually high share of its own feed gas just to run, and capital-intensive bets that did not pay off. The outcome for shareholders is different as well. Enron stock went to zero, and the company was liquidated. New Fortress shareholders are set to retain roughly 35% of the reorganized company under the current plan, even though the stock has already lost close to 99% of its 2022 peak value. And the legal process itself is different. Enron went through an adversarial Chapter 11 bankruptcy in the United States. New Fortress is pursuing a consensual restructuring plan under United Kingdom law, with a parallel Chapter 15 filing in the United States, simply to get that plan recognized here, a deliberately less destructive path than the one Enron took. So, what does the Enron precedent suggest about where New Fortress is headed? Not liquidation. That much is already built into the restructuring plan on the table. But Enron's story does suggest something about what tends to happen once the gap between a company's public narrative and its internal numbers becomes public. Trust does not come back quickly, and it does not come back on the company's own timeline. Enron's stock was worth $90 a share before the truth came out, and worth pennies within months of it. New Fortress followed a similar arc, falling from a peak above $54 to roughly 90 cents in the 2 days after its March 2026 announcement, and it has not recovered meaningfully since. The Enron case also suggests that once regulators, auditors, or investors start asking hard questions, more problems tend to surface, not fewer. Enron's own restatement in 2001 revealed damage well beyond what the company had first admitted. New Fortress's own auditor, weeks after the restructuring announcement, was still willing to sign the company's books only alongside a formal warning about its ability to keep operating as a going concern. That is the kind of signal that, in Enron's case, arrived only weeks before the bankruptcy filing. Whether it means the same thing here is not yet settled. What is settled is that New Fortress now carries a version of the same warning Enron carried in its final months, and markets, this time, are not waiting around to find out how the story ends. It is worth being precise about where this comparison stops working, because the differences are not small print, they are the whole point. Enron's collapse was, at its core, a fraud story, fabricated earnings, concealed debt, and a criminal conspiracy that sent its chief executive and chief financial officer to federal prison. New Fortress has not been charged with fraud, and nothing in the public records so far equates its governance failures with Enron's engineered deception. Calling the two situations the same kind of collapse would misstate what has actually been proven, in either case. The financial mechanics are different too. Enron's profits were mostly fictional. New Fortress's losses appear to be real. Money spent on debt service, on an LNG plant that has not performed as promised, and on expansion that outran the cash coming in. The legal paths diverge as well. Enron was liquidated through an adversarial United States bankruptcy. New Fortress is going through a negotiated restructuring designed specifically to keep the company operating and to leave existing shareholders with a meaningful stake, rather than wiping them out. And the scale of the fallout is not comparable. Enron's collapse rewrote federal securities law and ended one of the country's largest accounting firms. New Fortress's situation, serious as it is for its investors, creditors, and the communities in Puerto Rico, Mexico, and Brazil that depend on its power plants, has not, at least not yet, produced anything close to that kind of systemic consequence. The honest version of this story is not that New Fortress is the next Enron. Both companies show what happens when years of debt-funded, mission-branded growth run into a balance sheet that can no longer support the story being told about it. As of this reporting, none of this is finished. New Fortress's restructuring plan still needs sanction from a UK court, recognition from the United States Bankruptcy Court through the Chapter 15 cases filed in May of 2026, and approval from shareholders, with completion targeted for sometime in the third quarter of 2026. The stock was still trading under $1 as of late June. Multiple securities law firms have publicly announced investigations into whether New Fortress insiders breached their fiduciary duties to shareholders. In Puerto Rico, the open question is whether the bankruptcy process gives the island's government any opening to renegotiate or exit its power plant contract with New Fortress's subsidiary, Genera PR, a contract watchdog group say has been used to push for gas sales that may not serve ratepayers. None of that has been resolved either. What the Enron precedent offers here is not a prediction of fraud, and it is not a guarantee of liquidation. What it offers is a pattern. When a company spends years marketing itself as a mission while quietly running up debt it cannot service, the reckoning tends to be more sudden and more total than the company's own language ever prepared its investors for. New Fortress still describes its restructuring as a landmark step toward a leaner, more stable future. Enron, in its own final months, used almost identical language. Whether New Fortress's story ends differently depends on the parts of this record that are still being written, the court hearings still to come, the audits still ahead. The question of what happened to the money between 2023 and now, what is already written is this. A company that called energy access a human right spent a decade borrowing heavily against that claim, paid its shareholders more than $1 billion along the way, and is now asking a UK court, a United States bankruptcy court, and its own remaining shareholders to accept 91% less debt in exchange for the chance to keep going. Enron never got that chance. Whether New Fortress deserves a different ending than Enron got is a question the courts, not the company's own press releases, will end up answering.